And so one thing I've been pointing out for years is that you can have a multipolar world where Chinese currency is kind of the main currency over in East Asia. The United States' dollar is the currency in our hemisphere and other parts of the world, and Europe's is kind of their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies over time. Funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent.
Since taking office in January, the Trump administration has outlined ambitious plans to revive American industry, protect domestic jobs, and reshape the global trade landscape. But as macro analyst Lyn Alden explains, the real task goes much deeper. It's about correcting structural economic imbalances that have been building for over 40 years. At the center of this problem is the U.S. current account deficit. In simple terms, America consumes more than it produces and fills the gap by relying on foreign capital. This includes not just trade deficits, but income flows like interest and dividends. Over time, this pattern has become embedded in the U.S. economy with profound consequences. Foreign investors, flush with U.S. dollars, buy American assets like stocks, real estate, and government debt. While it may seem like a fair trade, sending paper in exchange for goods, this flow of capital has gradually shifted economic power. Wealth gets concentrated in financial hubs like New York and Silicon Valley, while traditional manufacturing regions like the Rust Belt are left behind. This dynamic has led to the slow erosion of America's industrial base and deepened the regional inequality we see today. A few years of imbalance might go unnoticed, but 4 decades of it? That creates political discontent and a fractured economy. For the Trump administration, this is both a massive challenge and a rare opportunity to restructure the system. In today's video, Lyn Alden unpacks how these imbalances developed, what a rebalanced future might look like, and how assets like gold and cryptocurrencies could play a key role. If you find this kind of analysis valuable, make sure to hit the like button, subscribe to the channel, and turn on notifications. We bring you the insights that mainstream media often ignores, so don't miss what's coming next. Thanks, and enjoy the video.
I can imagine the administration's challenge of trying to communicate this because the intricacies of how trade deficits and the reserve currency kind of pair together is very wonkish. It kind of has this academic quality to it that doesn't go over well in kind of political-oriented speeches. I would be terrible at a political rally, for example, when I try to explain any of this. And so we kind of have this situation where, and this was outlined back during the Bretton Woods system by Triffin, as you mentioned, which is that having the reserve currency does come with a bunch of benefits. Is historically called a exorbitant privilege, but then it has certain costs to maintain it. And those costs can vary a bit depending on how the system's structured. So, for example, back in the Bretton Woods era, the cost was that we kept draining our gold reserves. We basically had to kind of keep paying out our gold reserves to maintain that part of the system. And in the current formation, instead, we kind of pay for it with our industrial base. We keep kind of sending out little parts of our industrial base over time to maintain the global reserve currency status. And there's a few reasons for that. One is that because unlike every other fiat currency, the dollar has all these extra demands for it by countries all around the world. All these different purposes, there's this extra demand for dollars, which sounds good on the surface. And as for Americans, for example, we have tons of import power. When we go on vacations to the rest of the world, we have pretty strong purchasing power compared to when they come to the U.S. These things seem good on the surface, but it also means that it's pretty expensive to manufacture lower margin things here at home. And so we have this kind of situation where our imports are very strong. Our exports, especially lower margin stuff, is less competitive, whereas we can still be competitive on really high margin stuff, technology, finance, healthcare, that kind of thing. And then the other aspect is that even if you could somehow solve that, there's a more fundamental problem, which is that the whole world needs dollars for the global reserve currency status to use it for international contract pricing, cross-border financing, one side of every trade pair that they do, all these different purposes as a reserve asset. And when you step back and say, well, how do they get all those dollars? If they're all using dollars, how did all those dollars get out there? And the answer is trade deficits. Basically, that overvalued aspect forces open the U.S. trade deficit. And every year we send out hundreds of billions or sometimes $1 trillion in net outflows. And over years and decades, these have accumulated out there. And so kind of the way it works is that if you want to fix the trade deficit, which I've been writing about since 2019, I think that's a valid mandate to do. Unfortunately, it does come with trade-offs. Some of the benefits that we enjoy at the cost of the trade deficit, if you do want to kind of fix that imbalance, it comes up with basically giving away at least some of those benefits and prioritizing that industrial base a bit more. And so basically the opposite side of a current account deficit, which is basically the trade deficit plus things like interest and dividends. So we run a structural current account deficit, and the opposite side of that is a capital account surplus, which is that funds flow in the rest of the world and buy our financial assets. And so it's the trade deficit is often described as us sending out pieces of paper and getting goods and services, which sounds like a really good deal. But then the extra step of that you mentioned is that they take those slips of paper, or really those electronic digits that they have, and then they buy our stocks, they buy our real estate, they buy our private equity, they buy our corporate bonds and government bonds. And so they end up owning a larger and larger share of corporate America as part of their kind of accumulated trade surpluses and reserve assets and international private assets. The consequence of this, if you kind of like view the foreign sector as an intermediary, we're basically constantly kind of taking economic vibrancy out of Michigan and Ohio and rural Pennsylvania where the steel mills were. We're kind of taking it out of our Rust Belt, causing it to become the Rust Belt. And then we're stuffing it back into financial assets in New York and Silicon Valley and certain other places, mainly along the coasts. And this went on for approximately four plus decades, really ever since you can say kind of the early 80s. This really kind of started. And these are cumulative. So 1 year of that is not a giant deal, but when you have 4+ decades of it, that causes major imbalance. And a lot of academics will say, well, there's still room to go. This is not kind of an emergency. But on top of that, there is this political overlay that basically that voters get angrier and angrier when they're on the wrong side of that imbalance. And although many of them, they don't work in finance, they might not be able to articulate the exact mechanisms that are causing it, but they have this feeling that something's rigged against them, that something is just not right, that they're constantly going uphill, that they're on a treadmill. And so we start to see this it manifests in rising voter populism. It manifests in different priorities when people vote. And so I do think that there's a pretty strong mandate to try to go after the trade deficit. But I think the way I look at it is that because it's decades in the making, the best that any kind of one term can do is try to, start changing the direction of it. But it's inherently kind of a multi-year, potentially multi-decade project to kind of fully reverse these really long-term trends.
The Global Reserve Currency Challenge was introduced by economist Robert Triffin in the 1960s. Triffin's dilemma, or Triffin's paradox, is an economic theory that highlights a fundamental contradiction faced by any country whose currency is used as the global reserve currency. At the heart of the dilemma is a conflict between international and domestic economic objectives. For the global economy to function smoothly, the world needs a reliable and abundant reserve currency to facilitate trade, investment, and financial stability. This means that the country issuing the reserve currency must supply enough of its currency to meet international demand. The only way to do that is by running current account deficits, effectively sending more dollars abroad than it receives. However, running persistent deficits creates problems at home. Over time, it leads to growing levels of debt, inflationary pressures, and a weakening of the currency's perceived value. Eventually, this erodes global confidence in the reserve currency, threatening its stability and reliability. In other words, The very act of supporting the global financial system undermines the strength and credibility of the reserve currency. A historical example of this was the collapse of the Bretton Woods system. In that era, the US had to provide enough dollars to support global growth, but those dollars were supposed to be backed by gold. As more dollars flooded the world, doubts grew about whether the US had enough gold to back them. This ultimately led President Nixon to abandon the gold standard in 1971, ending the Bretton Woods Agreement. Even today, the Triffin dilemma remains relevant. The US dollar is still the dominant reserve currency, and the United States continues to face pressure to balance the world's need for dollar liquidity with its own domestic priorities, such as managing debt, controlling inflation, and protecting the value of its currency. The paradox is that solving one side of the problem often worsens the other, making it a persistent challenge in global economics. According to Lyn, the only way out is a multi-pronged, long-term solution to address the deep-rooted economic imbalances. Let's get back to the video.
I think I would separate into three things. One is kind of the mandate, two would be the plan, and three would be the execution. And I think the issue is that they start off good and then they kind of deteriorate as you go through those three steps. I think the mandate is there. So there's some people in politics that would disagree that the mandate's even there. They say we shouldn't be going after the trade deficits or they're not a big deal. I disagree with that. I do think that, and I've been writing about this for years, that the imbalances have become big enough that they're actually starting to really matter. Financially, politically, they're actually a big deal now. And if you don't ever focus on addressing them, given the network effects involved, eventually it forces itself closed anyway, but that's from a position of weakness. So it's better to kind of get ahead of it before it's kind of fully metastasized and there's really no options left. You generally want to try to correct it from a position of strength. So I do think that there is a genuine rising mandate to reverse some of these multi-decade flows that are basically all going in one direction. So I think that part is sound. The second part would be the plan. And if you look at probably the smartest version of the plan, it would be Stephen Myron. That's Trump's chair of the Council of Economic Advisors. He's an economist, and he laid out this paper back in November 2024, so right after Trump was elected. And he outlined it was like, I forget the exact title, but it's like basically how to realign global trade. And it's this paper that kind of articulates the problem. So he talks about Triffin's dilemma. He talks about the overvaluation of the dollar due to its uses as a global reserve currency, how the cost of that is basically undermining our industrial base, making us less competitive in manufacturing, and how some of those imbalances where the downside of that system have surpassed the benefits of the system for America broadly. And so he kind of analyzes different ways that this might be addressed, and then also goes over some of the risks of addressing them. Like it's not treated as like a surefire solution, but like if we were to go about this, what are the ways we could do it? What are our options? And they include things like, starting with some mild tariffs, which kind of is like if you treat it like a carrot and a stick, that's the stick. And then when there's kind of multiple mild tariffs on that are somewhat disruptive, that they could do some sort of currency accord, a series of trade deals that are in the United States' favor, that could then bring down some of those tariffs and start to maybe balance out trade somewhat. Then he faces the issue of, okay, well, what's next? What's after that? Because there's still the issue that if you want the dollar to be the global reserve currency, you have to supply the world with dollars. And so he focuses on, well, one, you could give up some of the reserve currency status. So it's not a Boolean thing. It's not like you either have global reserve currency status or don't. It's really a percentage thing. And so one thing I've been pointing out for years is that you can have a multipolar world where Chinese currency is kind of the main currency over in East Asia. The United States' dollar is, the currency in our hemisphere and other parts of the world, and Europe's is kind of, their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies, which we mean Bitcoin. He uses the phrase cryptocurrencies. And so over time, funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent. And then there's also various mitigants, because if you weaken the dollar, you risk higher inflation, you risk higher bond yields at a time when fiscal deficits and U.S. interest expense are very high. So he talks about, as part of trade negotiations, terming out the debt, convincing countries like China or Japan to increase the duration of their treasuries and basically agree to get like their reserve assets inflated away. And so I think the plan overall, it's articulated, described. I'm somewhat critical of it because I think it overestimates the U.S.'s negotiating position and overestimates the willingness of other large countries to kind of play along with that. But it is, I would say, a semi-realistic picture of kind of, if you were to describe how it would work optimistically, that's kind of how it would go. So that's the plan. And then when you look at the execution, that's where I think it got messier because, they ramped up tariffs super high, super quickly, that in many cases were so high that they hurt us as much as some of our trade adversaries. And even, it takes years to reshore and build a manufacturing base. So if you throw on really high tariffs right away, we pay the consequences right away, but we don't really get the benefits anytime soon. And so other countries like China can just say, well, we'll just wait then because, your tariffs are hurting yourself as much as you're hurting us. And so far, the U.S. has kind of rolled back some of those tariffs. They made exemptions for like Apple and phone makers. They made exemptions for automakers. And the problem there is that you're basically exempting big businesses, while little businesses that make all the widgets we don't think about, they have all the uncertainty and all the problems. And so now there's groups of small businesses asking for tariff exemptions. And so I think that the overall outcome is that they're not going into the next phase in the negotiating power that Stephen Myron would have, hoped for, I think, as articulated in that paper. So I think when you go from mandate to plan to execution, each step was kind of a little weaker than the prior one.
As Lyn Alden makes clear, the economic imbalances facing the United States are not just short-term distortions. They are the product of structural forces that have been building for decades. Fixing them won't happen overnight, and it won't come without cost. However, within this massive challenge lies a rare opportunity: the chance to rethink the foundations of the global financial system. And at the heart of that new foundation could be Bitcoin. When Lyn talks about a multipolar monetary world, she's not describing a scenario where the dollar shares space with the euro or the yuan. She's pointing to a world where neutral, decentralized assets like Bitcoin and gold become key pillars of global value storage. These assets don't answer to central banks. They can't be printed into oblivion, and that's exactly why they matter in an era when fiat systems are showing their age. In her view, the most realistic path forward is one that gradually reduces America's dependence on endless deficits and also shifts global reserves away from overconcentration in U.S. assets. That creates demand for alternatives, and Bitcoin stands to be one of the biggest beneficiaries. It's programmable, provably scarce, and global. In a financial system plagued by rising debt, devaluation, and diminishing trust, Bitcoin offers something radically different: credibility without counterparty risk. And make no mistake, this shift is already underway. From institutional accumulation to nation-state adoption, the signs are clear. The old system isn't collapsing overnight, but the new one is rising in parallel, block by block. For those paying attention, the signal is unmistakable. Bitcoin is no longer on the fringe. It's becoming the backbone of a new economic order. So if you see what's coming, if you believe that sound money, decentralization, and digital resilience are the future, then now's the time to act. Like this video to support independent analysis, subscribe to the channel for more deep dives you won't hear on mainstream news, and turn on notifications so you never miss the insights that could help you stay ahead in this rapidly changing world. Thanks for watching.